Hello agents, hello everyone. So today I'm going to talk about the fixed indexed annuity. Fixed indexed annuities are a product that kind of linked to the index. Not really, they don't really have anything to do with the stock market. They're insurance products. However, the way they credit is going to be based on what the performance of those indices do, and they kind of relate back to the annuity at that point. So this is my favorite crediting method. Of course, I've done plenty of videos on the annual reset, annual lock-in, point-to-point cap. I like it the best because it's really simple, easy for everyone to understand, and available across pretty much the entire marketplace. But this one's really unique because it offers some guarantees that most of the other ones do not. So let's jump right into this annual reset product that I find very good because you know me, I love my guarantees. So let's look at this as a chart here and how basically go through really quick how an annual reset, annual lock-in works. So assuming you're up the first years, you're up a couple years, that means this gain right here are locked in every year. And if the S&P goes up, you re-lock in those higher S&P numbers as well, right? That's where your starting point is based off of. So in this case, in this illustration, I'm saying it goes up for 5 years. After the 5th year, we have a negative year or a flat year, or pretty much a negative year. It can go down. Now you reset that down year, whatever it's down, you reset those numbers. So if the S&P 500 index went from 1,000 to 800, your new crediting base is going to be based on the 800. And then at the next year, if it went from 800 back up, you would pick up the gain again. So you're in the same territory you already made gains in over here. You're picking them up again because it locks in and resets in the lock-in of the gain and the reset of the number, right? So in the final year, if it was down again, there you go. You would not lose any of the previous gains and end the year, end the term at the end with all the gains without participating in that final down year. So 100% of the gain, basically 100% of what the S&P grows up to the cap, whatever the cap is. It's pretty simple. You can kind of look at it and say, hey, I went from 1,000 to 1,100. That's 10. My cap is 9. I made 9. It's locked in and reset. Now I'm at 1,100 and I'll go on from there. So that's pretty much how that works on the annual reset. So let's look at an illustration here. So this illustration here shows the 9% cap, assuming $100,000 went in, right? And you're going to make these gains. So in the first year, it's 9,000. You got the full amount and it went to 109. The next year, see these compounds, so that 9 earns on the 109. Now you're at $9,810 interest earned that year, and your accumulation value went to 118. And now, as you see in the 4th year, there's no gain, right? The S&P went down, the indice went down. You earned $0, but as you see, the year before 129, and that year 129. The next year it went up again, right? We don't know how much, right? But it went up and you made $11,000. So probably 9% compounded on top of that 129. Now you're at 141, and so on and so forth and down the road. What I love about the index is most of them, they don't have these 30-day windows. At the end, you're liquid. You can stay for a month, a year, decide what's going on, see how they renew your caps and all that good stuff. But there is zero true liquidation at the end of the year. And that can be shown here in the 8th year, where the accumulation value and the surrender value match off. The 7-year, even though this says it's a 7-year, this assumes you left in the last day of the 7-year. That's why you'd have a surrender charge. But if you waited to the first day of the 8th year, you'd get this 153,829. So these are based on the assumed values, assumed returns. And but there's other buckets. So I'm using this 9% bucket. But this company also offers an 11% bucket. But I like the 9% bucket because it locks it in. It won't change. That 11, all these other numbers here, they can change. The company can change them at any time. That 9, they can't change. Once you've decided on it, they can't change it. So let's take a look at a history. A lot of these illustrations have a best, a worst, and a last 10 years that you can look at. Now, again, these are on hypothetical values. These are not guaranteed. The guaranteed on most of these are 0. Like if it was down the whole 10 years, your 100 would be worth 100, maybe a little bit better if they have some kind of minimum, maybe 101, 100 to 110. Not a lot. There's not a lot of minimum guarantee in these products. So we're looking at this one here. This is guaranteed not to reduce this cap at 9%. The other one is an 11% cap, but after the first year, this 11 may change. They don't illustrate a change, so it's hard to tell. When you're looking at these, you got to ask your agent for a history, how good the company is. But we're going to take a look at the risk of taking the lock-in versus taking the higher cap. And as you can see, it can be substantial in 10 years, this one product with the 9% cap would have only grown 100 to 199, whereas this one in the best 10 years would have grown to 227, right? And that's assuming these returns here, 7.14, 8.56. Now, if you look at the worst 10 years, we're at 507 and 584. Now, again, these are assumed values. This is all assumptions. It could wind up just being nothing. But, you know, taking a look at historically, there's never been a 10-year period. So, but there's no guarantee that past performance will equal future performance. But assuming it does, we want to look at these numbers. So looking at the worst 10 years, let's just look at the worst. You're at 507, the worst with the 9% that you know can't move. Even at the 11 that can move, it made 584. So where is the fixed annuities, like the fixed rate annuities at right now? Well, they're a little better than 507, not as good as 504. So if you like 5 and you don't want to take a chance for the best 10 years at 7, you know, that's a 2% spread. You can just lock in a 520 or 530 today for the next 10 years and be done, or the next 5 to 10 years, you're in the mid 5% range, low to mid 5% range. So the index is good for the people that are okay with taking a little risk or going for this extra percent here, even if there's extra 80 points, or to wind up somewhere between 7 and 5, 7 and 4. You know, that's where you're going to look. So it's a little more risky than the person who wants just like, you know, I like CDs at the bank, where paying me every year. That would be more like a multi-year guarantee fixed annuity, where these, you know, your worst case is actually zero, you know, contractually, but that's assuming the market would have to be down. You know, the indice you choose would have to be down every year for those 10 years. Not saying it couldn't happen, but that's your risk reward kind of scenario right there. And the biggest risk on this 11, right, it could do better, but the company could lower it, and the minimums are usually very low, like 2, 1, 2, 3%. So if the company just got really jerky and wanted to drop it, they could. But this 9, that's why I like it. I like guarantees. I like when you don't have to trust the insurance company. That 9 is 9 for the next 7 years with this company. So that's really good. I really like that. It can't change. And again, if you want to take a shot at the 11 and you want some 9, you can diversify inside the contract. Say, hey, put 50 at the 9, 50 at the 11, and you hope for the best. But right now, in the best I've ever seen, these caps were, you know, in the mid-teens. But right now at 11, that's pretty darn good. And a guarantee of 9 is, you know, it's unheard of for the last decade or so, pretty much. So really good. Indexed annuities, kind of a feature to look for again if you're looking, you know, at a little more risk and you want to take a chance, but you still want your money guaranteed and all that good stuff. So that was my little disclosures. You could pause the screen on that. That's the end of my presentation. In the end, the indexed annuities, again, are a viable option. I like anything when you start getting 9 or over % cap, because they will outperform, they can outperform a fixed rate. So for the client that is okay with a 0 year, or maybe, you know, taking a shot, a little more risk, you know, an indexed annuity might be a very good option for them going forward. And keep your eye on those caps. And if they go up even higher, it'll be even more attractive. But once they start dropping into the 7 range, they're much less attractive. So again, ask for the history and all that good stuff. If you have any questions on FIAs, fixed indexed annuities, been around since the mid-90s, and I've been working with them since. So 800-373 right there. You can give me a call. Any questions, follow me on LinkedIn, YouTube, and all that other good stuff for the most up-to-date information. Try to do daily updates on those platforms. So in the end, have a great weekend. I hope you enjoyed this video and an introduction to the indexed annuity, annual point-to-point cap, annual reset, annual lock-in. It's good stuff. Talk to you soon. Have a